Hi, my name is Steve Walker from Promise Money, and in this short video I want to bring you right up to speed on what's happening in the second charge market, briefly touch on some of the problems of the last few months and what's been going on there and how we're moving out of this, and tell you about some really exciting new products which are on the market right now. So let's just go back in time a little way, back to the beginning of COVID, where lenders really tightened up their criteria. Everything got very, very tight. LTVs went down, required credit scores went up, affordability calculations, they were a nightmare as well. Buy-to-lets were affected, loan sizes were reduced, all sorts of tightening of criteria, which pretty much brought the industry to a halt. And then in June through to October, we started to see a little bit of relaxation from the lenders. So lenders coming back with new criteria, LTVs increased, so Optimum brought out their 95% product again. The surveyors started getting back to work, so that was good. We could get deals completed. A bit more latitude for the self-employed, up to 85% with Optimum and Surebrook. Optimum reduced their credit scores, so all the time things were changing. Rates started to drop. Buy-to-lets came back to the market because they'd virtually disappeared, so buy-to-let second charges came back up to 75%. And lenders started to look a little bit more favourably on income which involved bonuses, and also looked a little bit more favourably where there's a little bit of poor credit. And then from November through to now, we've seen, again, LTVs relaxing more, loan sizes increasing, minimum income criteria, that's relaxed with some lenders, and minimum income on buy-to-lets as well. So it's just all generally got better. But there's no denying that we still have problems around affordability for people who are in either a certain sector or in a certain have a certain profile of their income. So yes, if applicants are on payment holidays, well, they really need to be out of those. But lenders are now looking at those better than they did before, because before you had to be out for quite some time. They're now looking at it and saying, okay, well, if you're out, you're out. Furlough, you've got to be back at full-time work. For the self-employed, there's still a challenge there, because the accounts could be a year old, could be 2020, early 2020 accounts, but lenders for self-employed are going to be looking at very carefully what impact has COVID had on your business. Let's have a look at the bank statements and let's make an assessment on that. So that's still an area which is a little bit tricky. Bounce back loans. If you talk to most businesses that we get inquiries for a commercial loan, most of them say, oh yeah, I've taken a bounce back loan, well, it was there, so why wouldn't I? It's cheap money, and we get that. But of course, for sole traders or businesses who've taken those out, that can have an impact, because at some point they've got to start paying interest on that, and that's going to be factored into the affordability. So lenders are looking at that as well. And of course, we've then got the impacted sectors, such as travel, leisure, a lot of retail sectors, and hospitality. So all of that factored in does give us challenges right now. But lenders do want to lend, and they are looking for green shoots, and they are optimistic. I think they got their criteria pretty much sorted November time, with the expectation of an additional lockdown. So when the lockdown came around, the second one, it didn't really have too much impact, really. Lenders were used to it. The criteria was already prepared for that. They're looking for green shoots now. They are looking to lend. They want to lend, but they've got to lend responsibly, obviously. And as brokers, we've got to advise responsibly. So they are looking to see that these problems have been overcome and are improving. But as each week goes by, and hopefully we are now moving into a phase where COVID is less of a threat and there will be more relaxation, then it's going to get easier and easier. So is there anything to get excited about at the moment in the second charge market? Well, I think we can be fairly excited about the future, and I'll touch on that a little bit later, because the worst does appear to be over. So we should only see improvements in criteria, and we should only see improvements in customer attitude and customers seeking out second charges, but there is definitely a built-up demand which has been stifled for a long time now. So people have not been doing things aspirationally, they've not been doing their home improvements, they've maybe not been investing as much into their businesses because they're nervous, and consumer confidence has been low. So as we go over the coming months, I think we're going to see a big increase in inquiry levels for this type of finance. But when it comes to innovation from lenders, with some exceptions, there hasn't been a lot because lenders have been hunkering down to get through this. But we have seen some really new exciting products come to the market. So I just want to spend a few moments just to tell you about those in case you've not heard about them. So there are three key products. Unfortunately, back in November when these came out, we were one of the pilot brokers who launched these products, and we've seen a massive interest in them. So they're effectively three different types of product. They work in a very similar way, but there's three different types of products, and they're great for landlords or property developers or consumers where you need flexibility. And when I say flexibility, we're talking about in the amount that you need. So they work like an overdraft, and you get a facility. So a typical scenario for a consumer could be, right, I need to budget for school fees over the next 5 years, and I need to know that the money's there, but I don't need it at day one because I'm going to be drawing it down over the next 5 years or so. It's a facility that works for that. And the reason it works so well is because you can have the facility, but you only pay interest on the drawn down balance, and you can flex it up and down at will without penalty. So it's really, really flexible. So if you look at a scenario like bridging, and we've got lots of property investors, property developers using this product now, rather than buying a property or doing up a property using bridging finance, which is costly, they are taking out these facilities and saying, right, well, I'll use this facility to do this work that I need to do now, and then I'll pay it down again. And it's costing me nothing, and it'll just sit there until the next opportunity comes along, and then off we go again. So it's really, really flexible in that regard, and in terms of cost it's pretty competitive as well. So let me just give you a little bit of information. So consider this as a fighting fund that you might compare with a bridging loan, or you might compare it with a secured loan, but it compares well. So there's a regulated product and there are two non-regulated products. The regulated obviously secured against the main residence, the non-regulated secured against one or multiple buy-to-lets. You only pay interest on the balance outstanding at the time. There are no ERCs, so if you want to get out of it and switch back over to conventional finance, you can do so. In most cases there's no lender fee, so it's cheap to get into. In most cases we rely on electronic valuations. So if you imagine a scenario, and I've got one at the moment where a guy's got £29 million worth of property, and he's thinking, right, can I create a facility secured against a number of these properties? If you only need electronic valuation, it's £25 a time, okay, rather than £200, £300, £400, £500, £600. So it's very cheap in that regard as well, and they'll end up to 75% loan to value. Okay, so no ERCs. No penalty to flex up and down, no valuation charges, apart from maybe an AVM for £25, and no lender fee option as well. So there you've got a fighting fund that can be secured against one or multiple properties by first charge, second charge, or third charge, subject to consent from the previous mortgagees, obviously. And the facilities are available from £25,000 up to £1 million. So you've got a massive range there. Where else can you get £1 million without a full valuation? I don't think you can. So much more flexible and cheaper to set up than the likes of bridging and development finance, and you can dip in out of it and use it when you want to, and then refinance it or just use it again and again. So in terms of underwriting on the product, it's fully underwritten on an I&E basis for two of the loans, where it's 6 times LTI, so that's good. 3 months employed, 12 months self-employed, but we need a clean credit score, okay? And there are basically 3 different types of product. Firstly, there's the regulated product, which can be first charge, second charge, or third charge. And it's a 5-year, first 5 years of the loan, you've got this flexibility for the loan amounts to go up and down. Draw down, repay as often as you like within the facility that you've set up. At the end of 5 years, it converts to a term loan, which can be over 20, 25 years. So because it's a long-term loan, effectively is in cost terms isn't a huge amount different to interest-only products, and the other interest-only products that are on the market are more expensive. So you're getting a capital rate and repayment product costing you less per month than many interest-only products. So that's pretty good. The business loan works in the same way. It's the first 5 years you can flex up and down, and it's on capital and repayment. And then after five years, it converts to capital repayment on a fixed term and a fixed amount. But you've got that flexibility in the first 5 years. So just like the regulated product, you could have a £250,000 facility, but you've only drawn down 50. So the repayments are calculated based on 50 over, let's say, 25 years. You increase it to 150, and the next month they calculate the repayments based on the 150. So the repayments flex up and down as well to match the balance. That's how those two work. And then the third product is really aimed at property investors. You've got to have a number of buy-to-lets, and it's an interest-only product secured on multiple buy-to-lets. Now the rates on this one are a little bit dearer. It's only a 3-year term, interest-only. Rates around about 8%, but that compares pretty favourably with any second charge bridging loan. But unlike a bridging loan, you haven't got all of the setup costs that you would have, and you haven't got the flexibility to move up and down. So it's still competitively priced, whereas the regulated product starts at 4.45. Okay, so for a lot of borrowers, this is taking the need away for expensive bridging products, expensive development products, and for consumers, it's giving them a lot of opportunities as well. You know, if they're going to do home improvements, but they don't know exactly how much they're going to need, massive flexibility, and it can be used. Even the regulated product can be used for business purposes. So, if you have the equity in your main residence, and you're also a property investor, well, why not raise it on your main res? Because it's cheaper, but you can use it in your business, any business. Okay, so really exciting products. Do get in touch if those sound if they're of interest. Now, in terms of looking forward to the next 3 to 6 months, well, I don't think anything massive is going to happen in the next month or two, because we know where we are in lockdown at the moment. But I think we are just going to see a gradual easing of criteria. I think we're going to see increasing consumer confidence. We're going to see increasing lender confidence. And I think eventually there'll come a tipping point where everybody suddenly gets a feel-good factor, and at that point the pubs will be rammed, the restaurants will be rammed, and people are going to be thinking aspirationally again. So home improvements will be back on the cards. There'll probably be quite a lot of debt consolidation going on, and people investing in their business. So I think seconds are really, I think we're just going to, it's going to feel like a bubble has burst for second charges at some point, and that's when it's going to get really, really busy. So for brokers, that's great news. I know a lot of mortgage brokers are really busy on mortgages at the moment, and possibly can't handle much more at the moment either. So if it comes to the point where you just need to hand off your second charges, then we can take those from you. Just a simple referral. We'll deal with everything, keep you posted along the way, so you know exactly what's happening. But of course, if you do want to stay involved and package the cases, then you can do that too. So I think the next 3 to 6 months, whilst we can't get overly excited, I think there's some exciting stuff on the horizon. But right now, there are some exciting products to get your heads around, and this flexible overdraft is definitely one of them. I've never spoken to so many landlords and realised how big their portfolios are. You know, there's some big ticket business to be had out there. So go looking for it, because these products are really, really excellent. Go to the website, you'll find some more information on the products there. And if you're not already signed up as a broker with Promise, then either one, go onto our website and register with us, or there's an option there just to sign up for our newsletters, and you'll hear about all these products as and when they come out and as they develop. So I hope you found that useful, and good luck over the next 3 to 6 months. But I think there's good times just around the corner. Thanks a lot. Bye-bye.